Two stocks to buy before the market recovers. That's it. That's the entire video. But before you trust me with your money's attention, you should test me. Now, 2 months ago, I had uploaded a reel on Instagram and YouTube, which is part 1 of this series, and talked about 3 stocks to buy before the market recovers. And 2 of them, IHCL and Medanta, have rallied. So IHCL is 13% up and Medanta 17% up in 2 months, while most portfolios were sitting flat and waiting for the market to make up its mind. So in part 2 of this video, I have brought 2 new stocks but from one sector. And this time the thesis is not mine alone. It comes from the most respected valuation mind on this planet. So keep on watching till the end because the second stock is the most interesting one and I am going to share buy plan of both of these stocks. Let's start with Ashwath Damodaran, the Dean of Valuation, the man whose framework every analyst from Wall Street to Dalal Street has used. And when he was asked which sector can be India's next big untapped opportunity, his answer was surprising. Not IT, not banks, not defense. His answer was healthcare.
Healthcare is going to become that discretionary product that people are going to access the most. And it's also a big chunk of money. So I think healthcare, is the space I would look at.
And here's his logic in 3 beats. Beat 1. He grew up in an India where people did not saw a doctor in their entire life. Not because they didn't need one, but because they couldn't afford one. Beat 2. Days before that interview, he drove down one single road in Chennai Poonamalli High Road and he counted 16 hospitals and MRI centers on one road. Beat 3. In America, healthcare is 20% of the GDP because when people get richer and older, health is the first thing that they invest in. And India is at the very start of that exact curve. And then Mr. Damodaran said the line that triggered this video. The real price of this theme is a potential 10-bagger stock. And this stock will be a company that builds a healthcare model tailored for India, not a copy of the West. And one of the stocks which we are analyzing today just reported fastest revenue growth in 4 years, sitting on 1,693 crores of pure cash. Imagine a business with these characteristics, each one rare on its own. So let's check them out one by one. First characteristic, zero debt. Actually better than zero, 1,693 crores of net cash. Second, the return on capital employed excluding that cash, 58% annualized. 58%. Most good Indian companies celebrate at 20%. Third characteristic, it collects its money in roughly 15 days. Most Indian businesses wait for 60, 90, 120 days to get paid. But this company almost gets paid instantly because 75% of their revenue comes from you and me. B2C, cash on counter. Fourth, the kicker last quarter. Revenue grew 19.1% year on year, which is the fastest in 4 years. EBITDA up 28.6%, profit up nearly 27%, and EBITDA margin 31%, the highest quarterly margin in its disclosed history. Now the question every intelligent investor should ask, was this growth bought with price hike? Because any company can juice up one quarter with price increase. So the answer is no. There was no general price increase. The growth came from volumes. 8.2% more patients walked through its doors and customers voluntarily bought more services per visit. So the company grew 19% without even using their biggest advantage, increasing prices. And the management has clearly said that they still have plenty of room to increase the prices whenever needed. But for now, the growth is strong enough so they don't need to do it. And you may already know this company. And if you live in North India, there is a good chance that you or your family members must have used their diagnostic services. Stock name is Dr. Lal PathLabs, India's most profitable listed diagnostic company with a market cap of 31,500 crore rupees. And their Q1 FY27 results are just out this month. And that is the reason it is in this video. And see, Quarterly results are not just numbers. They tell you whether a stock can move up or down in the future. If a business performance improves, investors may need to increase the weightage. But if the performance is weakening, they may need to reduce the exposure. But most of the investors just read the headlines and take no action. Let me give you an example. See, SmartWorks is a part of our Multibagger portfolio, and earlier we had given it a weightage of 3% of our portfolio. But after looking at its recent strong results and analyzing the improving business performance, we are considering of increasing the weightage to 5 to 6%. In simple terms, if we earlier advised investing 3 rupees out of every 100 rupees in SmartWorks, now we may increase it to 5 to 6 rupees. And the opposite is also equally important. If the results were disappointing or if the business outlook weakens, then it is very important to reduce the allocation to manage the risk and protect the overall portfolio. So this active tracking is what we do at RangaOne Finance. We closely analyze the results, the management commentary, and then we tell our clients whether to buy more, hold, or reduce the stock. And this is how a portfolio remains actively managed rather than becoming a collection of forgotten stocks. You can visit our website RangaOne.finance and explore our model portfolios, Stability X Growth and Multibagger portfolio today. Now coming back to Dr. Lal PathLab, let us understand what its Q1 results are actually telling us. So in Q1, revenue was 798 crore, which is up 19.1%. EBITDA 247 crore, which is up 28.6%, and PAT 170 crore, which is up 27%. And the patients grew 8.2%. So let me show you the machine behind these numbers, because that is what you're actually buying. First is the network, 312 labs, 7,727 patient service centers, nearly 14,000 pickup points. And here's the strategic genius. 39% of revenue now comes from tier 3 and smaller towns, which are growing at 16.7% CAGR over 3 years. And here I want you to remember Mr. Damodaran's point about healthcare reaching the India that never had it. And Dr. Lal PathLab is literally executing that thesis. They are even running a rural program called Gramin Fit, which is active in 7 states, which served over 1 lakh patients in this single quarter. Second is the bundling engine. Their preventive health package Swasth Fit is now 27% of their revenue, growing around 20%, and the average patient now gives them 3.14 tests per visit, which is up from 3.07, and revenue per patient just hit 968 rupees, which is up 10%, and I repeat, that is without a single price hike. So that is not pricing power being used, that is pricing power being saved for later. Third, the cash machine. FY26 free cash flow 463 crore rupees, and in Q1 alone net cash grew by 167 crore rupees, which is roughly the entire quarter's profit converted straight into cash. Now, and this is where I'm different from influencers who just show you the good picture. Here's what is not perfect, because you deserve to see the entire picture. Point number 1. Out of that 19.1% growth, about 2 to 3% came from a one-time government tariff revision, the CGHS price reset. Now that benefit expires in 2 to 3 quarters. So the sustainable core growth is around 16 to 17%. Still excellent, but not 19. Point number 2. Q1 is seasonally the strongest quarter, and the 31% margin will not hold for the full year, and management themselves are guiding 27 to 28%, and anyone thinking of 31% margins is fooling themselves. Now the third and the most important point, the valuation. At 1,878, the stock roughly trades at 58 times trailing earnings. Not cheap, but the research is brutally honest. The business earns a buy, but the price earns a hold. And the fair value zone would be between 1,700 to 1,750. And the smart entry would be accumulating on dips below 1,700 rupees. So what should we do? See, this is not a buy at any price kind of a stock. This is a know your price and wait like a sniper stock. The management has met or beaten their own guidance for 8 consecutive quarters. Now these are conservative people who underpromise but over-deliver. So when a stock like this dips, that is not a red flag. That is a gift. See, buying the dip is a gift, and if you buy at the wrong time, then you're damaging that gift. Take Eternal for example. If you would have bought the stock around 330, 300 rupees, then right now you would be zero gains in the last 2 years. Whereas we recommended buying the stock near 230 rupees on March 17 with a holding period of 3 to 4 months. Now, why at that level? Because the stock had previously taken support near 204, and when we saw a strong reversal around 200 rupees, that is when the risk reward became attractive. Now we achieved our first target of 266 and our second target of 305, and we have booked partial profits in the stock, and now we are holding the remaining quantity for a higher target of 350 rupees. And our clients received every update: when to buy, when to book partial profits, how much quantity to hold, and what target to aim for next. So this is what you get at RangaOne Wealth Basic Plan. Not just a stock name, but complete guidance right from entry to exit. And the basic yearly plan is currently available at a special discounted price, and you will receive swing trade and short-term recommendations along with instant updates through our Telegram channel and website dashboard. So just visit our website rangaone.finance and subscribe to the basic plan today. Now coming to stock number 2, and this is the one I am more excited about. I'm going to show it to you in a strange way. I'm going to start with the thing that looks wrong. Now here are two numbers from the company's quarterly results, latest quarterly results. Revenue is up 33.2% and profit is only up 13.2%. Now most retail investors see this and run. Margins are falling. That means something definitely is broken. And that reaction, that exact reaction is why the opportunity exists, because smart money reads both of these numbers backwards, and by the end of this section, so will you. But first, let me tell you where this company actually lives. It is 2 a.m. A young couple's newborn, 3 days old, suddenly can't breathe properly. They rush to the nearest big hospital, and here's what most people don't know. A general hospital's ICU is built for adults. A newborn needs a NICU, a neonatal ICU. Different machines, different nurses, a completely different clinical world. At 2 a.m. with your 3-day-old child in your arms, there is exactly one question in your head. Where is the best place in this city for my baby? Not the cheapest, not the closest, the best. No parent, rich or poor, negotiates on price at that moment. The decision is made from the heart and the wallet simply follows. Now, what if a company built its entire business model around being the answer to that 2 a.m. question? One listed company in India did exactly that. While every other hospital chain Apollo, Narayana, Max was going broad into cardiology, oncology, orthopedics all under one roof, this company refused. They picked one specialty, children and mothers, and they became the undisputed best at it. Now let's have a look at their numbers. Revenue 470 crore rupees, up 33.2%, record Q1 growth. EBITDA 134.65 crore rupees, up 29.9%, and PAT 60.57 crore rupees, up 13.2%. But why is the profit lagging the revenue so badly? See, the company is in the middle of the most aggressive expansion in its history. It added 440 beds in FY26 alone, including acquisitions in Guwahati and Warangal, and has 980 more beds in the pipeline, including Mumbai, Coimbatore and Pune, and a massive 450 bed cluster in Gurugram to conquer the NCR market. But before I reveal the name of the stock, let me explain you how hospital economics works. And once you understand this, you will never misread any hospital stock. So on year 1, a new hospital is a loss-making machine with around 20-25% occupancy but bleeding money. By year 2 or 3, they come to a break even with around 35 to 40% occupancy, and year 4 onwards, they become a mature 30 plus margin cash cow. Stock name is Rainbow Children's Medicare, and when Rainbow commissions hundreds of new beds at once, these new beds temporarily eat the profits which mature hospitals generate. And Rainbow runs at 60% occupancy with 35% EBITDA margins. which are the silent cash cows funding the entire expansion. Read the two numbers backwards now. Revenue up 33%, which means the expansion is working, patients are coming. And that profit up only 13% is the company deliberately paying today for a much bigger revenue engine tomorrow. The market sees margin dilution, but the smart money sees 980 beds moving along a predictable maturity curve. Now that is the whole mystery solved. And if you look deeper, the average revenue per occupied bed grew 8%, not from price hikes but from complexity. Deliveries surged 22% in Q4, gynecology surgeries up 20% in FY26, and the IVF fertility business 61 crore rupees of revenue growing 25% a year. So higher complexity cases, higher value and structurally rising realizations. Here are the risk factors. Risk number 1 is execution. And Gurugram and Mumbai means fighting established giants in their home turf and recruiting star pediatric specialists in India's most competitive talent markets. Now that is the number 1 risk. Risk number 2 is free cash flow stays compressed for the next 2 to 3 years while the capex cycle plays out. Now FY26 FCF was barely 1.3 crore rupees. So if you want instant returns, then this stock will definitely test you. Risk number 3 is the valuation. It is not cheap. About 54 times trailing earnings, roughly 40 times FY28 estimated earnings, you are paying a premium. But you are paying it for industry leading ROCE, a 40% jump in bed capacity already funded, and a moat which generalists cannot copy. So the research verdict is accumulate with a target price of 1,750 and horizon of 12 to 18 months, and earnings forecast is to go from 281 crore in FY26 to 385 crore by FY 2028. To be clear, Mr. Damodaran did not name any stock. The thesis is his, but the stock selection is mine. But of everything listed in the Indian stock exchanges today, Rainbow is the closest answer to his description that I can find. I hope you enjoyed part 2 of this video, and for part 3, comment below the video part 3 with the sector of your choice. And for swing trade and short-term recommendations, check out RangaOne Wealth Basic Plan, and for professionally managed long-term portfolios, check out RangaOne Model Portfolios. And if you have any question, just WhatsApp our team on 70213 37693, and I will see you very soon in the next video. Till then, bye bye.
Investment in the securities market is subject to market risks. Read all the related documents carefully before investing.